Hello, this is Edmund Shing from BCS Asset Management. Today, why you should buy European stock markets based on the European Central Bank, the ECB. US and European economies are growing, first of all. The US leading economic indicator, here the ECRI, weekly leading economic indicator, continues to break new highs, showing the strength of the US recovery. Here in this chart we can see a similar style of recovery for Europe, but this is stronger for the manufacturing sector in blue than for the more domestic services sector in the green dots. So it seems export companies are doing well, but domestic service companies are not doing so well in Europe. This is also evident in differences between country performance. In green up here, we see Germany doing very well in manufacturing, whereas down here in France, we see manufacturing in decline. Remember, on these PMI indices, above 50 is expansion, and below 50 is contraction in activity. So Germany's doing well, France is doing badly. Now, what has this got to do with central banks, and what are they doing about it? Well, we can see here that while UK 3-month interest rates up here and in blue US 3-month interest rates are stable, here in green Eurozone 3-month interest rates have been going up. At the same time, we can see here that US Federal Reserve continues to expand their balance sheet. So in other words, their quantitative easing program of buying bonds is growing their balance sheet as they support the economy. The Bank of Japan down here is doing very much the same thing in Japan. However, in blue, we see a different pattern for the balance sheet of the European Central Bank. It is going down from over 3,000 billion euros here to 2.2 thousand billion euros here. The difference being the long-term refinancing operations in which they lent money very cheaply to European banks for 3 years, expanded the balance sheet over here, but banks over here are repaying that money early to the ECB because they don't need it anymore. However, we see a big difference in credit growth between the US, where we see growth of loans to companies is doing well in green, whereas in Europe, we see continued decline in growth. In fact, we see negative growth in credit to companies. In other words, companies don't want to borrow money from banks in the Eurozone, which is of course bad for economic growth prospects. So, what can the ECB do? Well, why do they need to act now? They need to act now because we can see this blue line coming down. This is monetary conditions getting tighter because the euro down here in green has got stronger. It's moved from €1.28 against the dollar to more like €1.35, €1.36. So the stronger euro is proving a problem for exporters and therefore for economic growth. Moreover, inflation continues to come down sharply in the Eurozone from over 2.3% in early 2012 to just 1% currently. So that 1% suggests that we are close to deflation. And the bond market, look at the blue line here, the 30-year German government bond yield has come down more substantially in the last month than in the US or the UK, suggesting that the bond market is starting to expect the ECB to do something to stimulate the Eurozone economy. To sum up then, there is a lot of pressure on the ECB to act because of deflation, because of negative credit growth. What can they do? They can execute further unconventional monetary policy, such as a further long-term refinancing operation to inject financing liquidity into the economy, and particularly if they did like the Bank of England and targeted it at small business lending, that would be a good thing. They could even go for full-blown quantitative easing, i.e. buying bonds. So far they haven't done it, maybe they will need to. That should weaken the euro, which in turn would be good for exporters, which is why I like, at a sector level, industrial companies, aerospace, and autos, because they should all benefit from a weaker euro and stronger exporting growth. The types of companies that we like are companies such as BMW in autos and ThyssenKrupp in industrials, both of which feature currently in our global equity portfolios. This is Edmund Shing from BCS saying goodbye.